Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Paul Brodsky and Ira Harris. Paul is managing partner at Postmodern Partners, managing an aggressive cross-market investment fund. He has professional experience as a trader and risk manager on Wall Street. His experience runs the gamut across asset classes, strategies, and geographies. Ira is a hedge fund manager, global trader in foreign currencies, bonds, commodities, and equities for over 40 years. He has served as CME director from 1997 to 2003, and also recently. Welcome, gentlemen.
Thank you. Great to be here.
Thanks, Richard. Pleasure as always.
Great. I thought we begin with a general discussion on the global economy and financial markets, your views and perspective. Paul, would you like to go first?
Sure. So it seems as though we're in a stage where we've never been before. And that's whenever one hears that and it's been around for a while, you kind of get a little skeptical. But I think the zero interest rates around the world has really changed everything and raised the level of awareness about the limitations and involvement of central banks here and around the world. It seems to be, I think it's obvious to some of us that central banks are really not the economic monitors that we've come to believe, but they're really more of a financial entity and a very aggressive one at that. So I think the watchword is caution. I think more than ever, it's very, very difficult to fight central banks, and specifically the Fed. And that it should be your first and last indication about how to treat financial assets.
Great. And your thoughts, Ira?
No, I think that Paul, as we step off and go into this today's adventure, I think that's absolutely right. And all you do is have to look around. It's like people, my mailbox was full, on Thursday and Friday. This is the Fed is so hawkish. This is the end of the reflation trade. And as I blogged, I wrote 2 blogs since then, and I did one podcast with Anthony Crudele right after the Fed, and I don't see it. And then yesterday we had Powell testify to the House subcommittee on the coronavirus, and his testimony there was diametrically opposed to everything he talked about Wednesday. Because yesterday he was back into the as I call it, the social justice ministry, when he wants to bring everybody who lost jobs through his language, through no fault of their own, back. And that I think, puts the Fed in a very difficult situation and allows the politicians, and you saw it yesterday, in listening to it and watching it, that it's an abdication of responsibility by the politicians. And I know Biden with the infrastructure project, but there's just not the necessity and the speed to do real infrastructure and social investment, because the Fed has taken on the role. And as Chuck Schumer said in 2012, you're the only game in town. Well, that's a terrible, terrible situation to be in, and the Fed has taken on that role, and I think to its detriment. So we'll take off from there. But do I think the reflation trade is over? First of all, I think it's a bad phrase, and I don't get into the transitory, non-transitory, because I can tell you right now, energy prices are above where they were at the Fed press conference. Copper prices have retraced all the way, and that's with yesterday's announcement from the Chinese that they were releasing 20,000 tons. That's 20,000 tons of copper from the stockpiles. And I go back a few months ago with David Rosenberg when he says, well, how do you know that the Chinese are stockpiling? So I guess they must have stockpiles if they're releasing it. But I have great respect for David Rosenberg. I'm just tweaking him a little bit because it was on his podcast. So, and yet copper prices are now back to they're actually closing higher than they did than last Wednesday's Fed press conference. So I'm not looking at this as transitory, and I'm not looking at just reflation. I think what you saw Thursday and Friday was specs who were highly leveraged got their clocks clean, so to speak. And I think that's a healthy thing for the market, by the way. And we needed to see it in the way the interest rates moved. But that allows us to jump off of some big discussions here.
And what are your thoughts, Paul, on the inflation question in terms of transitory or sustained? Which way do you see it?
Well, it's a simple question. I'm going to give a kind of a layered answer if I could, because there's a couple different types of inflation that I think many of us are interested in. A few observations first. First, sustainable inflation cannot occur without bank system manufactured money and credit growth, because without it, there wouldn't be enough liquidity to pay higher prices. That kind of goes without saying. The second thing I'd say is that sustainable inflation, or central banks, I should say, communicate to the public that consumer inflation is derived directly from the expectation of it. In other words, suppliers of goods and services raise prices when they expect their future costs to rise. And they tend to, taking the sentiment from Ira, they tend to kind of put it off on a more economic cause than what it is they're doing, which I'm a little dubious about, shall we say. And the third observation I'd say is that banking systems can't produce consumer inflation if economic participants don't play along. So despite the much heralded Fed money printing recently, consumer inflation, not asset and not commodity, to Ira's point, but consumer inflation has remained questioned during the pandemic, thanks to precipitous fall in velocity, monetary velocity, how often a dollar changes hands. So my point is we're looking at a kind of a two-tiered inflation outlook. What the Fed wants to put out there is that consumer inflation is going to be transitory or temporary. I honestly don't know. It could be if, as Ira knows better than certainly me or anyone else, the best solution for higher prices in the commodity sector is higher prices themselves. So if that causes demand to drop, then you might see some deflation in the commodity space down the road. I just don't have an intelligent point of view on that. But in terms of asset prices, I think it's fair to say that there's no possible way the Fed or any other central bank is going to allow asset prices to fall. And so the better bet, I think, is to bet on rising asset prices over time, regardless of their underlying fundamentals. And I think that's really more of the trend that we've seen. I think if we are to see temporarily, I think, rising interest rates or a rising dollar or both, that would then invite declining risk, a decline in the price of risk assets. I think you'd see the Fed step in and begin up their purchases, their asset purchases, not taper them at all, which gets into the second aspect of Fed policy these days. The reason, I think, is because portfolio balance sheets can't go down because they serve as collateral for all the debt out there. don't have to tell this audience how much debt there is relative to GDP, both in the U.S. and around the world. So if we don't want contracting balance sheets, if we don't want deflation, then the Fed only has one choice, and that is to raise their asset purchases, not to taper them. And so I think the Fed more than ever has your back as an investor. Wish it weren't that way. I wish there were freer markets, but we have to play the hand we're dealt.
Interesting. And Ira, would you like to elaborate further on the transitory?
I think Paul, some really says, we play the hand that you're dealt. You can't, people were getting mad at the market. You can't get mad at the market. The market is still, after the 44 years I've been doing this, and I know from talking with Paul that it's 40 years, to get mad at the market is silly. The market is still, even with the Fed's intervention and all the other central banks intervening, as Paul elaborated so well on, it's still the most objective force we have on a day-to-day basis. So you can't lock up with it. And if the market gets over leveraged, leverage is a blessing and a curse. When you're leveraged up and the market is going your way, be it up or down, it's a wonderful thing. But when the market corrects from what your position has been, it's a painful thing when you realize the power of leverage. And I'll tell you, it's the same thing when I talked with Anthony Credelli. I was kind of surprised with Paul Tudor Jones the other day that he didn't talk about it. China has a much bigger role in this, not only from an absolute user. I believe that the Chinese and the Russians are active traders in the market, which makes the markets even more vulnerable, and why you have to be patient and really be aware of everything that's going on. We saw it yesterday. The Chinese announced that they were releasing 20,000 tons. That's 20,000 tons of copper. That's 1,600 contracts in futures terms out of their stockpiles, and 30,000 tons of zinc, because prices, they believe, have gone too high for their users. But I would argue that they've been the ones buying for the previous 9 or 10 months, especially between grains and raw material goods. And those are assets, as Paul talks about. The Chinese aren't fools. They have a depreciating asset called the dollar. Okay. And for those who are bullish, good on you. And we'll see where interest rates go to support a dollar. But the dollar still, with all the hoopla, is still, I'm looking at the euro 119.25. If it breaks 113, I'm talking about the euro. I will then get neutral the dollar anyway. Right now, I'm still not bullish in any way, shape, or form. And I think the Chinese played a very good hand, because they did something last year, which was, to me, was to tell in the game. I've talked about numerous times now, Richard, is that when the world economy was buckling, and we saw the response to it, the yuan started a path of appreciation, which has been diametric to everything that everybody's pushed, which is, the Chinese will go to any extremes to protect their export sector. But that was not what they were doing. The yuan was rallying while the global economy was on its knees, and raw material prices from grains through metals were on the rise. So I think it was very telling that the Chinese were stockpiling. And that was a smart thing to do, because not everybody can buy Ferraris and Mona Lisas and Jackson Pollocks. That the Chinese were buying things that they knew that they were going to use, and they were taking a depreciating asset called the US dollar and putting it into a hard asset with great utility value. So I think that's a bigger part of the global price rise than anything else. And then, of course, you get the specs who pile in, the momentum players, the ones who I grew up with and I'm very familiar with, and they ride it until they can't ride it. But I think the Chinese said, hey, okay, these have gone high enough. And it started, if you go back 5 or 6 weeks ago, for the first time in a few years, they actually capped, when the corn was up at its high, the Chinese announced that they were canceling some shipments of U.S. corn. So, and the corn dropped 35 or 40 cents that day. It came back the next day, but that put a kind of lid into these markets. And I'll just And with this yesterday, we heard from the Chinese, and over the last 2 days, we've got I think a 16-cent rally in copper prices, which is, a 4 or 5% move in copper prices, with the Chinese announcing that they were selling from stockpiles. So pay attention. Yes, the yuan has weakened since the FOMC press conference, but it's really hasn't really done it. It weakened by about 2%, but I have my eyes on the yuan as being very indicative of what's going to go on here.
Your thoughts on that, Paul, in terms of currencies, before we get into cryptocurrencies, just currencies in general, the Chinese yuan and other currencies?
My view is that it is not terribly nuanced. I think we are going to continue to see relatively stable exchange rates. Certainly, China is going to be very active in trying to maintain a stable exchange rate, and as is the U.S. My general view and my concentration over the last few years has really been in bigger stuff, meaning potential significant disruptions to that. And so I think what I'd like to do is everything that Ira said, I think sounds about right, but that's really hasn't been my area of focus over the last few years.
So you've been focused largely on cryptocurrencies. What are your thoughts on China's central bank digital currency as a government-based cryptocurrency?
I think it's meant to be a threat and a potential savior, potential threat to the current global monetary regime, a potential savior to the unbanked out there that don't the people in nations where they don't really have access to major currencies, or they rely on the goodwill of those of us in developed economies with strong currency boards, and they are providing an option to them, and the central bank digital currencies probably won't be adopted by G7 nations or those economies with strong fiat currencies anytime soon, unless they are one day forced to by the markets. I honestly don't see that happening until some technological hurdles are overcome, but and there's no way to put a time on that as a result, because we don't know when the tech finally hits and when it's adopted. But I think it's reasonable to say that those of us in the West will be including more blockchain-oriented tokens and cryptocurrencies in our lives probably within 5 or 10 years. It's going to become more and more predominant. It's just software. That's all it is. It's nothing we should be frightened of. And at the same time, your direct question about China and other nations looking to insert a blockchain cryptocurrency and call it a yuan, I think that's in the cards, and they're going to try and roll that out to places like Africa and other places in parts of Asia and South America. I think that's how it plays out.
And your thoughts, Ira?
Well, I defer to Paul, because if you take my investment record on Bitcoin, the view is right. The investment record is pathetic. I think, and I think Paul really speaks to that with his blockchain. But when I look at what the Chinese are doing, and I'll wait to hear from. I'll just ask this: that if the Chinese were to go to a central bank digital coin, which I think Paul's 100% right. I think they're going to do this, but I perceive, or conjecture, I don't perceive anything, I conjecture that it'll be by necessity somewhat backed by, and through blockchain, it'll be backed by a modicum of some precious metals, which I think would really, China's a disruptor. They love disrupting the world as they see it. It's all part of it. Their rise disrupts the world order as we know it. Now, whether they make room for it, that's the question that we face for the next decade, is certainly laid out beautifully in the Thucydides trap. But it's Paul, do you see the Chinese possibly utilizing some percentage of the value of their digital coin with any type of precious metals to give it credibility?
It would certainly. The honest answer is I don't know, and I have no. There's no way to tell. What I've learned over the decades about central banks and currency boards more broadly is that they like to maintain control over their the exchange rate of their currencies, and I'm a lapsed gold bug from from the early aughts on through 2013, and one of the disappointments I had was that it seemed to me that the economic participants out there, consumers, merchants, what have you, corporations, and economists, Keynesian economists in the West, just don't care about the absolute value or the purchasing power loss of currencies. The thing about a blockchain cryptocurrency that may or may not be backed by gold or some other finite resource is that do they have to do it to to have their way? I don't think they do. I think most people will just take the whatever mandates their sovereigns tell them, and they will use those currencies according to the policy, whatever that might be, of the currency board. And that's how 2/3 of us in any economy behave, and so that's what they'll get away with. If it turns out that there is hyperinflation in China or the U.S. or any other region or country, obviously there's going to be the compulsion to find some finite resource. That's frankly what the promise of Bitcoin is, per se, not necessarily the other cryptocurrencies, but a Bitcoin that has become digital gold. I don't think that the Chinese, that the Politburo is going to voluntarily link the yuan to gold, whether or not it's on a, they distribute it on a blockchain. And the reason is because they probably won't have to do it. And so they probably won't.
Yeah, you said that they probably won't have to. So we differ a little bit there, because I think in order to get the international credibility, what takes place within China itself, that's a whole different discussion. But if they're going to rival the dollar, it'll take some modicum of sustained credibility, and I'm not sure that they're going to get it as quick as Xi, I think, would like to. So I don't, but again, it's mere conjecture. None of us know,
right.
And where they're going to go. But my basis is, they love disrupting the world order. It's all part and parcel of it.
Well, I think it could happen when we think about. I don't know how much we're actually disagreeing, because when we think about currencies per se, it's really bank system currencies, certainly in the West. Right? as most of our listeners know, it's the banking system that effectively controls the quantity of money and credit, and they do that at the they do that as an agent of the Treasury in the U.S. and of other Treasury ministries around the world. And really, there's no check on that. So, that's not necessarily the case in China, where the PBOC is really total, is tightly controlled by the Politburo. And so they can act more autonomously than Congress in the U.S. trying to get a hold of its banking system, which has a different set of incentives. So it comes down to bank systems, highly developed bank systems like the one we have in the U.S. and they have in Europe and parts of Asia, trying to promote their currencies and credit in their currencies versus China, that can go to places that are unbanked, like Africa, and say, well, wait, we've got a more definable currency here that you can use in your daily spending once it does work at scale, which it doesn't yet, by the way, blockchains. But you can do this. We're going to call it a yuan, and we are going to control it. And from now on, when France ships wine to Brazil or something like that, you won't have to settle that trade in U.S. dollars. You can do it in yuan, and there's much less friction. It's much more efficient for you to do so. So, yes, I would agree that that China, that it certainly is a threat if they were to do this, and using a blockchain and reducing the friction that now takes heavy toll from trade, that could provide incentive for global trade to shift from the dollar as the reserve currency to the yuan.
Interesting. And in terms of cryptocurrencies, will in the future governments allow private-based cryptocurrencies to coexist alongside government-based cryptocurrencies, or maybe only if fully regulated within the financial and banking system? Your thoughts on that for long term?
So my view is that ultimately they will, because they'll have to allow private blockchains and cryptocurrencies that travel along them to exist. Where they'll probably end up is that treasury ministries, governments are probably going to have to be okay with tracking commerce along a blockchain at every step of the way, which they can now, and they'll be able to do, and taxing it, taxing consumption on a blockchain. And really, the problem is for banks. It's not for governments. It's for banks. They're going to lose a lot of their verticals. Let me. I don't think it's as far off as many think, due to the scope and pace and likely impact of digitization, which we've already seen over the last 20 years. I mean, everyone knows how far we've come, and how it's disrupted, retail and all other sorts of commerce. Imagine, it seems reasonable to assume that advancements in blockchain ledgers, cryptography, and decentralization will make it possible for everything to be fungible. Technologically enabled peer-to-peer barter with a very low barrier to entry, like a smartphone, will allow anything of value to be exchanged for anything else. Imagine ongoing rates of exchange calculated automatically and algorithmically, someone buys a purse, a high-end purse that equals 3.5 high-end Louboutin shoes, or 800 odd Starbucks lattes. I mean, digitization is going to allow an exchange rate not only on money probably, but on anything that has a value. Currencies and IOUs would be needed to sop up the value differences in transactions. Credits and debits would be stored on the device with multiple backups. And economic participants could store their liquid purchasing power in whatever currency floats their individual boat. Most commonly, in the ones most others accept, it's just software. No social, economic, or political ideology needed. And so, if it's a dollar, it's a dollar. If it's a yuan, it's a yuan. If it's a Bitcoin or an Ether or whatever other token we all adopt and migrate to, because, or it could be, Facebook comes out with what they've been talking about and they use their $2.5-3 trillion customer base to buy and sell goods and services on their platform peer to peer. That could be the future. How commerce and finance is enacted, is created, is manifest. So it's going to be interesting to see. And again, guys like Ira and me, and many listeners that have come up through the ranks of an analog system. It's very challenging to make this, to say, well, okay, there's no central authority, there's no hierarchical policy that comes down on which we have to abide, but it's more of a, policy will be set by whatever the rules of the open source software is. And, is that pie in the sky? Is that crazy? Yeah, maybe, but I kind of think that's the direction we're headed. And the kids that are driving this are, they're brilliant coders, and they're bumping into things that they're discovering things for the first time that we may have known for years, but they're getting there. And ultimately, when these blockchains do work at scale, which they don't yet, you can't, the throughput per second is not as high as a credit-based system like the dollar system or a fiat system. You can't do, Visa will do 20,000 transactions a second, whereas Ether will do 14, or maybe it's up to 100 now or something like that. So it can't happen all at once. But when it gets there, I think we're going to see a different model for commerce and finance. Sorry to have rambled there, but I think that's interesting. That's the future.
Mm-hmm. And your thoughts, Ira?
Yeah, I listen. Paul is much more in depth on this and understands it far better than I can lay out. But I've cautioned people that Wall Street's going to be turned upside down if Paul's right, because the stock lending business, which is an enormous earner for Wall Street, is going to disappear. I have to believe that, along with other fee-induced businesses. So, Wall Street pretends that they cheer this on, but I don't really think so. So, Paul, what do you think about that?
Oh, I do. I think not only, there's a lot of bank verticals that are going to be disrupted. We're already seeing the advent of decentralized finance, or DeFi, as it's called, where cryptocurrency holders are borrowing and lending and receiving interest on their crypto. Our fund has chosen not to do that yet. because I'd like to see a cycle or two and make sure that it's as safe as the developers hope it is. But I'd like to see that develop more before I do it. We have no idea about rehypothecation. A lot of it is opaque, so on and so forth. But I think, if you just look over the valley in 5 or 10 years, you're going to see DeFi, take share from centralized banks that are controlling the flow of assets and therefore controlling how much you can borrow and how much you can lend and interest rates on them. It's going to be, I think, peer-to-peer, decentralized lending and borrowing. And in theory, we would feel comfortable with that because because blockchains are immutable and you can and they're encrypted, and so you'll be safe at some point in thinking that you will get your asset back. And there's going to be fits and starts, but I think that's the direction we're headed, and it'll get there.
Interesting. And
we're already seeing, Richard, transfers from one country to another, from Africa to elsewhere. A migrant worker in the States can send money back to the Philippines or to Mexico without having Western Union take 10% of the principal amount that they're sending back home by using Bitcoin. And they don't have to know they're using Bitcoin. They just log on to an app on their smartphone and transfer the money. The dollars turn into Bitcoin. It's immediate. Immediately it travels to to the smartphone in Mexico, say, and it comes out pesos. And there's virtually no VID that is taken out of the transaction. That can't happen 20,000 times a second, but it can happen less, and that's already happening. And we're already seeing commerce on top of the Ethereum blockchain, but it's very slow and it's clunky, and where the tech isn't quite ready for prime time, but ultimately I think it's going to, and it'll change a lot of things.
There was a paper that was released, I think, overnight from the BIS warning, and I use that in its full, about digital coin, private digital coins, and governments really need to get on top of this. And I think it's interesting. The BIS, as I would say, it's not my father's BIS, even though he didn't even know what the BIS was, but it's a little different group. And I think some of the things that they discuss in reading just a summation of it, I think they're absolutely wrong about. So I'll wait to see how the market disentangles what they put out. But they're aware, and on top of what is coming, I will give it that, because I think there is great disruption that's going to take place in the global banking system. And a lot of it is due to the United States with their use of sanctions and other types of mechanisms where they control the flow of course, through the SWIFT system. The more you sanction, the more desire there is to find ways to circumvent the current transfer system and everything to go with it. So I've thought that the U.S. Treasury has way overstepped its bounds. First of all, because sanctions, all you do is give people an incentive to create ways around them. I could argue that the sanctions, people say, well, if they weren't, it would have been that much worse. Well, don't know. We don't know that. So, but I think you've given impetus for people to find ways around. There was a group who I have been advising over the last few years, Ninth Gear. I don't know whether you've heard of them, Paul. They do have a website, Marianne Morrow and others who are involved. So, I mean, they are working on strategies to try to upend the status quo of the large banking system. So there's so much money at work finding ways. There's plenty of people with big enough funds now to look for ways around this. So I think Paul shined a lot of light on that area.
Interesting. And wondering on the cryptocurrencies, there's been a lot of discussion recently on the environment impact in terms of the electricity required or energy consumption. Are there any cryptocurrencies that are more or less better in that regard, Paul? Like, that maybe use less electricity or less of an ESG impact for their mining, in terms of the coins, or what are your views on that?
Yeah, so the energy consumption that has been tied to Bitcoin specifically is it comes from the mining activity, as you point out, and that takes a lot of energy, a lot of computing power to power the computing power, it's been, especially in China, very much coal powered, and there's some hydro, there's some alts, there's some stuff like that, but it really stems from what's called proof of work, and that is you have to work to get the new Bitcoin and to validate each block along the blockchain. There are other protocols that are so-called proof of stake, where it is more reminiscent of what we're used to in the stock market, one share, one vote, that kind of thing. There's pros and cons to proof of work versus proof of stake. The pro to the proof of work is that it's what the product of it is very rigid and very safe, and it can't be hacked, can't be toyed with. Proof of stake is less secure, but obviously it has a benefit in terms of energy consumption as well as flexibility in programming the blockchains. What you're going to see is the direction we're already going is towards proof of stake. Ethereum is moving in the next year and a half or so from proof of work to proof of stake. That could be, or them, or Cardano, or Solana, or Algorand, or some other platforms, which may sound like a different language to some listeners, but they are looking to be the platform on which developers can create these commercial use cases. And they are driven by what's known as smart contract programs, where if this happens, then this occurs, kind of thing. Which those of us in options, in derivative markets, are very familiar with. It's just going to do that, and it's going to be contracts that we can believe in, because the oracle that is determining what happens in the physical world is also happening. Is also being determined in this blockchain world, is actually valid and true. So I have a feeling that Bitcoin per se is always going to be proof of work, and is always going to be an energy consumer. It is because it's so rigid, and because it has taken on the role of digital gold. And like gold itself, Bitcoin doesn't have to have a daily use case in transactions. Just like gold, we don't use gold in daily transactions. We'll never have to use Bitcoin in daily transactions either. I think as long as you have a group of believers, in this case, 100 million holders of Bitcoin. All they have to do is think it'll have a better store of purchasing power value than the US dollar or their local fiat, and they will continue to hold it, and thinking its exchange rate versus fiat is going to go high. So that'll probably stay the same, but I think most of the cryptocurrency market is going to go to proof of stake over the next 5 or 10 years, and that's going to not have the energy
I see.
consumption risk at all.
Interesting. And just a last final question round on your thoughts of investments that make sense in this environment, given your views on the global economy and the financial markets across all asset classes, commodities, currencies, equities, fixed income, cryptocurrencies. Paul?
Richard, I'm sorry, can you
Oh yeah,
repeat that?
just your thoughts on investments that make sense in this environment, just across all asset classes, including cryptocurrencies.
Well, obviously, I've spoken a lot about cryptocurrencies, and I'm sorry if that's not what listeners wanted to emphasize, but I do think that it makes sense to have some portion of a portfolio invested in cryptocurrencies, in some way, shape, or form. I think the negative real rates have taken out, interest rates have taken out the formerly very large allocation to fixed income all across, from treasuries to high grade to high yield. It doesn't make sense anymore when high yield bonds are yielding 3.54%, and the Fed is telling you that they want consumer inflation to rise above 2.5% for a little period of time. I think there should almost be a zero allocation to that, unless one is looking for price gains and think that yields are going to go negative, as they have in Japan and Germany and other areas of the world. But in terms of income, I think it makes zero sense to allocate to fixed income. Equities, I think, have become the new savings. Stocks, because there's no way to save risk-free anymore because of the negative real rates. I think equities are probably, as long as the Fed has their back, probably fairly safe. And if you can get anywhere from 8 to 12% a year, it's probably going to keep up with the rate of consumer inflation. Who knows? Maybe it's not, but it's going to get closer. IRA probably has a better sense of that, certainly when it comes to commodities. I think commodities I'm just going to leave aside because for Ira to comment on. My general sense is it's a much smaller market in just market cap terms and a series of more fragmented markets. So there's going to be great opportunities, but on a one-off basis. I do have a small position in uranium, and I'm just playing it through the equity market, really. But that's a one-off position that has nothing to do with anything on the crypto side or anything else. And those are areas, and really, I'm not a financial advisor, must I say. So please consult your own.
Yeah.
But that's kind of where I come down on the major markets.
Great, interesting. And your thoughts, Ira, on investments that make sense in this environment?
Well, which makes sense. It's a big area which makes sense. I think that Paul's right. I think equities will hold on here unless you go into the deflationary spiral, and I'm just not in that camp. Because I believe that the central banks fear deflation and will do everything that they can to prevent it. That takes me back, of course, to what I call Ben Bernanke, who famously made the case in a few speeches well before he was Fed chairman, by the way. And he, and 1937 is a critical year for him. And that's why I call, I tongue in cheek say they should have changed the name of the Washington Redskins to the 37ers, because I think Washington is built on the fact that they will do anything they can to prevent the deflationary spiral from taking place. And if you invest in that, well, yes, high quality equity stocks. And I'm not saying rush in to buy them. I don't believe that at all. I think we saw corrections take place last week. And because when markets get leveraged up, which they are, and markets are carrying a lot of leverage because money is so cheap. So of course there's a lot of leverage in the system. It will correct, but high quality companies that I still think I like the miners, and I like the ag sector, and it's served well over the last 10, 11 months. And that was really a play on China. And I think China still is going to be a dominant player, not only in the utilization area and actual usage, but they trade it too, as you see with their recent announcements. So equities don't forget, it's not only nominal negative rates, it's that real interest rates are negative in all of the developed world, right? You see a G7 meeting, should we go down the litany? Germany is a member of G7. I would say that real yields in Germany right now are negative 3%. I would say that in the US, and I'm using the short rates, well, although in Germany, it's probably the same with the longer rates, but it's a different discussion. But if I go to Canada, they're negative 50 to 60 basis points. In the US, look at what the 5-year did during the FOMC meeting when they talked about tweaking the reverse repo and the interest on excess reserve. We saw the belly of the curve get slammed, while actually the long end prices rose and yields dropped. And it was in the 5-year, which was probably the most expensive interest rate vehicle. We had a big auction today, which was so-so, but it was probably negative in real yield terms, 150 to 160 basis points. We're still sitting, based on whatever metric you use for inflation, at 120 to 130, if not a little higher, negative real yields. So in the negative real yield world, you need to shop accordingly. A good friend of mine called me the other day and sent me an email about some REITs, and I didn't really have enough expertise in that area. But my expertise was, if they're carrying way too much debt, I think you have to be careful to buy them. But I said, call your bank, and who had given you this, and I said, ask them what tell them you want to buy $1 million 6-month treasury bill, and you're buying it at discount, and see what you're going to earn. And on $1 million 6-month treasury bill, you will, if you bought it on Monday to carry, you would earn $300. Yes, I'll say that again, $300. So where do you go? And I think Paul and everybody else who looks and operates in this venue, we're all stuck searching for that. And we're trying to put together a portfolio that with the least amount of risk, with the greatest amount of upside. And if it only gets you 8 to 12 to 13% in that area, that's a phenomenal return. And if that's in high quality equities, well, then, you have to be prepared to jump in on them when they do correct. Was Wednesday, Thursday, Friday's correction and deep enough? Yeah, probably not. You have a lot of people out there looking. So this is a time, and it's one of the things that I've learned, by moving to the electronic platform over the last 20 years, is to be far more patient. And if you're patient, the algorithms, and those software programs that drive so much on a daily basis, will give you phenomenal opportunities. But I still think, and I don't call it the reflation trade. There are things that just need to be consumed in this world. And if you can buy them at a much lower risk tolerance when everybody, casts them aside. And if you want to say, well, the reflation trade is over and I'm going to get rid of everything, that has been good to me, fine. I'll wait. I'll be patient. So I'm kind of like Paul. I'm going to bide my time and look for those areas. So if I can buy them on a much lower risk level, then I'll try to get my rewards through dividends. Because bonds are a silly investment at this point in time. A 30-year is probably the most worthwhile investment. I don't want the duration risk because at least it's close to a zero real yield. It's still a little bit negative, but you're taking a lot of duration to get zero real yield. And that's the way I function and operate here. So anything within that I would look at.
Great. Just coming up to a close here. How can our listeners learn more about your work, Paul?
I'm at P. Brodsky, Brodsky, at postmodernpartners.com. That's my email address. Or you could go to accredited investors. They go to postmodernpartners.com, www.postmodernpartners.com. Thank you.
Great. And Ira?
Yeah, through the kind offices of Financial Repression Authority, and I'm still blogging, not as much as I was. First of all, there's just not that much to talk about. But I'm still from Notes from Underground, and really, getting the discussion going. And this was really good, Paul. I mean, you enlightened me with the cryptocurrencies and everything else that goes with it. So I appreciate it. And Richard, just getting this out there and getting the discussion going, I think is really good for a lot of people who have to wend their way through this investment world. And don't just take the first person who tries to solicit you with a sales recommendation. Use your heads, be patient, and know your risk tolerance.
Yes, good words of wisdom. Awesome. Thank you so much, gentlemen.
Thank you very much, Ira. It's a privilege and an honor. I appreciate it.
Paul, it's very kind of you, and hopefully we can open up some dialogue between us. I really, it was a pleasure listening to you, and thanks for the time.
Great. Thanks, guys. Yeah.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.